everyone, and welcome to today's webinar, Financial Strategies for Today's Market. I'm Andrea Frost, and I'll be your moderator. I work on the communications team here at the Capital Masters, and I'm really excited to be hosting today's session. We have two incredible panelists coming up. Bob Hernandez is the Treasury, Credit, and Finance Wizard here at the Capital Masters. For the past several weeks, he's tapped his extensive network of bankers nationwide to develop an insider's picture of today's lending climate. Rich Russakoff is an international speaker and experienced business coach skilled in creating the dynamic narrative and top-notch business plan that banks need to say yes. Together, these two are going to help you evaluate the best financial strategies for acquiring capital to not only survive right now, but create a strong post-pandemic future. Before I hand the mic over to our two experts, I do have a couple of housekeeping items to cover. First, today's webinar will be available on demand after the live session. Once the webinar is concluded, we'll email you a link so that you can access the recording. Also, we'd love to hear from you during today's presentation. If you have a question for our speakers at any time, please feel free to send it through the Q&A tab at the bottom of your viewing window. We'll save the questions for the end, and if we don't get to yours during today's webinar, we'll still be sure to follow up afterwards. Without any further ado, I'd like to kick things off. Rich and Bob, over to you.
Thanks so much. And Lucy, would you bring up the first slide for us, please? Now bring up the second one. One of the things I'd like us to start off talking about is being smart about choosing the right kind of debt. In the trade, it's known as the capital stack. Many companies get into trouble because they take on the wrong debt, or they take on debt that they believe they can handle, and they haven't done their assumptions right, and they're not able to grow their company, and their balance sheet is hurting because they have so much debt on it. So Bob, let's talk about what is a capital stack, and why is it important that you understand if you need debt, what to get, why to get it, and where to get the appropriate debt for growth and for capital operations.
Yeah, Rich, thanks for the question, and glad to be here today. The capital stack, if you go back, for any of you who have had business school, is one of those intermediate finance items that you learn about. It's, in its simplest form, how your company's capital structure is put together. For example, you might have raised stock to capitalize your company. Then on top of stock, you might have term debt for a building or for equipment. Then on top of that, if you're a manufacturing company or provide similar kind of services, you might have a line of credit on top of that. And then at the top of the heap, you have cash that's in the bank on deposit or in investment accounts. So the allocation of each of those is equivalent to the term the capital stack. You might have 40% in stock, 30% in debt, 20% in other financing, say asset-based facilities, factoring, lines of credit, and then maybe 10% to 20% sitting in cash. So it's the job of the CEO or the treasury officer, or if you have neither, the CEO, to determine what that stack is and how your company is going to be capitalized. And then within that, making sure that you're picking the correct facility with the correct attributes that match what you're trying to do. Otherwise, as Jed Clampett would say, you can get into a heap of trouble, boy.
So before you go on, Bob, I'd like us to bring up the next slide, and let's talk about that. When I had my first business, Lucy, can you bring up the next slide, please? Okay. When I had my first business, I got a working capital loan for leasehold improvements, and then I worked off of lines of credit. And along the way, I probably needed more debt to invest in a term loan, but I never understood it. I never figured it out. And therefore, I was using lines of credit for other things, and it was the worst of all worlds.
So is there a question there, Rich?
Yes, there is. Do you see that a lot? And what do you recommend so that you can differentiate between a line of credit and a term loan and be able to go to the bank and say, the line of credit's great, but I need a term loan or to add on to the term loan I have?
Yes, yeah, I see that a lot. And one of the biggest things that I see is the totally improper use of this kind of debt. And that manifests itself usually in companies that are fast growing, entrepreneurial, going out there and doing things that they know best. What do you know best? Well, I can get another credit card. What's a credit card? It's a line of credit. So they start getting multiple lines of credit, you know, 20,000 here, 50,000 there, 100,000 here. And then, you know, those payments aren't at exactly low interest rates. Most of those cards, whether it be, you know, the standard ones we all know and love, are, you know, 24% or higher in some instances. And then they need to have capital to pay those back because they have too many of them and it's eating up their cash flow. They go out and get one of those MCA loans, which is a daily or weekly sweep, and then it all blows up. When a little forethought in the beginning and discussion with a credit officer at a bank would have maybe told them, hey, with what you're doing, you know, a lot of that's really permanent working capital, and that's really better used for a term loan. So maybe for what you need to do, we need to get you a $50,000 term loan to buy equipment or uniforms or whatever you need, and then maybe have a small line of credit on the side for that gap between when you get paid to when you actually invoice somebody, which is called a timing gap in finance, and have different facilities that match what you're trying to do. It's like trying to put banjo strings on a guitar. It won't work.
So in so many cases, what companies do when they get in trouble, and there's a lot of problems out there that you all are facing with the need for capital coming out of the pandemic, assuming we're coming out of it anytime soon. So I see exactly what you see, where you call the equivalent of Guido and you pay a tremendous amount of money to get quick cash, and you're tapped out on your credit cards. And then the worst thing you can do is say, okay, I just won't pay withholding. And you use that money, and then one day the government catches up with you and all your assets are frozen and they own everything. So that's what I'm talking about when I say don't be dumb with debt, and look for other options to help you get through this because they are there. Bob, we're working with a company right now that is a trucking company, and they do refrigerated trucking along the East Coast. And we're putting together a package for them. And in that package, they need a term loan. They need a line of credit. They're looking to do more leasing of trucks because every truck they have on the road generates $250,000 in top line revenue. And I would like Bob to share with you, as we're putting this package together, where he sees the best capital stack for a company like that. And it would include things you might not think about.
Well, what actually happened with that company initially was that they were thinking they needed like a $5 million line of credit. And the more I probed as I was analyzing their financials, which it takes a deep analysis of your tax returns and your interim P&Ls, balance sheets, accounts receivable, accounts payable. You have to analyze all of that to determine if you can pay back the debt, what that debt should be, and how it should be structured. So when I was looking at that and going, well, they want $5 million to do, this, and they want it in a line of credit, I was going, well, you want to buy trucks. Well, trucks are considered rolling stock, and you're going to put a lot of miles on those trucks, hundreds of thousands of miles. So, I guess the wear and tear and maintenance, repair and maintenance on those things is going to be high. What's the most efficient way to handle that? Is that term debt? Well, maybe so. A cab's going to cost you 100, 200,000 plus the trailer. What if you could get a vehicle, and I mean an investment vehicle, that would allow you to not only depreciate the truck, but also capture back some of the interest expense on the P&L? Well, what does that? A lease. And leases aren't structured like loans. They're based on present value and future value time factors. So you can equate them to an interest rate, but not really. It's more of an investment vehicle, and they're short term, 3 to 5 years. And some of the leases have features like dollar buyouts at the end, or you can turn back the equipment and just roll it into new equipment. High-tech firms use that a lot for computers, since they usually, per aggressive depreciation schedules, work off in 3 years or fully depreciate in 3 years. So we looked at that. They wanted to acquire a company. Well, that's term debt, out of that $5 million. So you have a portion for lease, you have a portion for term debt, you also have a portion for expansion within the acquisition and their growth. And then depending on the spread of their receivables and how they get paid and what the receivables term and timing is, there's a line of credit there. Well, the CEO never thought of any of that. All he thought of is what he knew in his head, and that was a line of credit.
Well, Bob, for most CEOs, they don't have a clue what's available. It's not like it's easy information for them to get. And that's where somebody like you comes in when we do a package where you see options that they may not. So could you share a little bit more about other debt options, Bob?
Yeah, I mean, and it goes back to the first thing you were saying about the scenario where you had the smarter debt. I have or have been banking a customer since 2010 that is in the Northern California area, and they are in the high tech world, and they decided to go instill some expansion programs. They got in trouble, and they decided not to pay their payroll taxes.
Oh.
So that happened for a couple of years. Well, one thing that the IRS of recent date, say within 3 years, 5 years ago to now and moving forward, hates and will aggressively go after are commercial businesses who fail to pay their 940 and 941 payroll taxes. So these guys didn't do it, but it was to the term of several $1 million. They had SBA 504 and 7A loans in place. They had a line of credit in place for a couple of million, and they were in trouble. The IRS was getting ready to levy them. Well, what does that mean? Well, that means passports were going to be taken away. Personal residences of the CEOs and CFOs would be taken away. They would shut the company down. We had to move quick. So in that instance, instead of putting in the proper debt, I had to use alternative debt sources to pull them out of a jam. And what I was able to do was go in there and use bridge capital, which is another debt vehicle used for good and for bad purposes, and give them a 3-year break. But what I had to do to get there was refinance all of the existing real estate debt they had and allow the bridge lender to have a first lien position to be able to pull out the cash to pay off the IRS. Then I had to get them a new line of credit because the bank wasn't too happy when they found out they weren't paying payroll taxes. So bridge capital has its uses, and there's various levels of bridge. capital where investors can come in for 12 months up to several years. Rates can be anywhere from the 8s all the way to the 14s, and it's private investor money, and it works fast. There's also factoring and lines of credit outside of bank lines of credit. So those are just a couple of additional options.
So one of the things, go ahead, Bob.
Programs, period.
One of the things I wanted to say about factoring is if you use factoring for receivables, the interest rate sounds very high. But if you're collecting your receivables within 30 to 60 days, you're paying 1.5% per month on those receivables. And what factoring companies do is they don't work based upon your credit. They work based upon the credit of the people you're collecting money from. And that's why it can be the best alternative if you're in trouble. Anything you want to add to that, Bob, before we go on to the next slide?
Yeah, and it's also not for when you're in trouble, but when you're not at that level that you're really what I would call an A-level commercial customer with a bank. The bank's not ready to give you that large line of credit. Well, that's where the factoring companies can come in and be that bridge, so to speak, and jumping point to be ready to go to the larger commercial A-level bank facility. And there are some factoring companies, for example, one I have, they're charging 4.5% interest on a $2.5 million line with foreign receivables. So it depends on your credit quality and the credit quality of your clients. In that instance, the clients are tier 1, GE Capital, Hitachi. So, low risk clients, lower rate.
One more point I wanted to make on that. I worked with Four Hands Furniture. They're now a $160 million plus company. And for a period of time, they did a terrible job of collecting their receivables. In fact, early in the game, they didn't even know who owed them what. They just grew too fast. So we went to a factoring company that specialized in furniture, and they did all our collections, and we got our money on time, and they were well worth their weight in gold. And the other thing is, if they said, no, we don't want to take this one on, we learned quickly we shouldn't either. Let's go on to the next slide, Lucy. So Bob, you've been on the phone with bankers throughout the country for the last week or two. What are you learning about the bank's appetite for lending right now?
Yeah, good question, Rich. What I've been learning, and mind you, I've called banks from both sides of the spectrum, meaning very conservative, SBA and conventional, all the way to just pure, full-blown deal maker kind of bank that's doing SBA. But the common thread between all of them is they're going to want to see extremely detailed business plans. They're going to want to see credible, factual, and justifiable projections, assumptions that relate to that business plan. They're going to want to see that you're able to articulate how COVID has affected you as a business, what's happening now, what do you think is going to happen at the end of the year and next year, which is all part of the projections, but a separate section for COVID. They want to know how it's affecting you and your industry, and then they're going to check that against what they already know for that industry by researching your NAISC code, which is the National Industrial Classification Code for your industry. And
so Bob, first of all, when we work on a loan package, and this is what I'm recommending for everybody, do the financial analysis up front and see whether or not you have a viable loan and for how much. And that will depend on a whole host of factors. And then I'd like Bob to share that a little bit, because that's key. You can't move forward without it, and you need to know what you can ask for and where it fits in your capital stack. And then I want to talk about what goes into a narrative so that it complements the financial section and gives the loan officer and the guy in the back room where Bob used to be, who actually does the underwriting, the comfort level.
Yeah, one thing that you're taught when you're going through credit training, which today a lot of loan officers don't go through that, but some do, is you're always looking backwards. You're always looking at historical performance to dictate future results. So in this world, if you weren't cash flowing historically for the past couple of years, and COVID's made you look even worse, you're probably not going to get a deal. If you were cash flowing previously and things stopped because of COVID, then you may be able to get a deal. So what the credit analyst and the credit officer are going to look at are previous trends. Are revenues going up? They going down? Or do they look like a roller coaster? Is your cost of goods stable? Or does it look like a roller coaster? You're kind of getting the point here, or getting the picture. You know, same thing with your SG&A cost. And then they're going to look at your EBITDA and go, okay, they want a loan of X. You have EBITDA, or cash flow, earnings before interest, depreciation, and amortization, which is your cash flow number, divided by the principal and interest payment of proposed debt. Is that at a certain metric? And they all have a metric they look at. In the SBA world, it's 1.25 times. In commercial banking, it's usually 2 times. But in commercial banking, it's different underwriting, because they're looking at you as a guarantor in addition to the company performance. So it's totally different. So they're going to be looking at your trends. They're going to look at the industry and how the industry is performing, and maybe benchmark some of the industry metrics against yours to see how you fit in. So it gets quite detailed. It really doesn't have credit score and things like that have their place, but that's really, not where it's at when you're going into underwriting a deal.
So the first step, obviously, is have your financial house in order. And
Okay.
if you have that, then the bank has a certain comfort level to go with. In terms of what a package should look like, and everybody on this call, we're offering after the call a template on how to put together your loan package. And it comes with a workbook. And because you're on this call, we're giving it away today. And you can use this as a guide now or in the future. But what you're going to want to do is want to put together a very compelling executive summary on how you're going to use the money and where you are now, what's the opportunities, and how you're going to be able to pay back the loan with the uses of money. Then you're going to need to put together the purpose of the loan so they're very clear on that. And then a company section that says, this is who we are, this is what we do, and you have with that milestones from the year you opened to where you are currently, including now. And then the industry section, and I'm going to ask Bob to come back to that a little bit, is really critical, because banks need to know how COVID is impacting your industry, or if there's a pivot you made that enables you to take advantage of the market opportunities there. They want to see a management and ownership section, including your advisors, showing that you have a solid company in place and you've got the right team to do it. And then on top of that, they want to see that you have a solid sales and marketing plan to make it happen. Then the financial section, which includes all the things that the credit manager will assess, and you want to give that up front. All this is in our template. And then finally, exhibits that show off awards you've won. It shows contracts you have in place, certifications, and that is the kind of package you need today. And I think, Bob, that when you talk to the banks, they said it's the combination of the two that's going to bring a deal home.
Yeah, I mean, you know, for banks, it's how am I going to get repaid? Number one. Number two, how am I going to get repaid? And number three, how am I going to get repaid? And yeah.
I think I'm getting the idea that that hope is not a strategy, that not only do you have to have a strategy and an action plan, but to show you have the people, the market, the industry opportunities are there, how you're going to cash flow, which is why your projections are so important right now. And they need to complement that you've been successful in the past, because as Bob pointed out, banks look to the past to determine the future, whereas investors look to the future and they don't care what you did in the past as long as they see a clear path for the future. So let's talk about right now the programs that are in place and what you need to know about them. First of all, with PPP, it's been a great Band-Aid. It's helped a lot of company, and there's changing rules all the time about forgiveness. And what we're seeing right now is, because the program was so chaotic, that they may throw in the towel and forgiveness might be 90 to 100%, because nobody knows how to go back and recollect the money with the resources they have. Bob, you want to talk about that? I don't want to spend too much time on PPP, but how does it work? How do the banks get paid, and what's required of the banks, and what do you see changing by way of forgiveness?
Well, how the banks get paid, they're really, to my knowledge, from bankers I've talked to, not getting paid right now. It was codified in the Code of Federal Regulations when the bill was passed back in March, that banks would get a 5% premium for doing these. I don't know that that's even going out yet, because banks really weren't prepared, and the program wasn't rolled out properly. Right now, the program was slated to end June 30th. It's been extended through August 8th. You can use the funds to cover costs over the next 24 weeks or until the end of December. It used to be 75% was only allowed for payroll cost. Now you can use that has been lowered to 60% to allow you to use part of the funds for other things. You can extend the frame to rehire people from June 30th to the end of the year. You don't have to make payments on the forgivable amount of the PPP until that forgivable amount's paid to the lender. Loan terms now 5 years was 2, and you deferred taxes on funds till next year. So there's a few changes, but it's a moving target. This thing was a debacle the way it was rolled out, and everybody who had to administer it was caught off guard, and that allowed a few extra players to jump in at the end there. But I'm thinking, as well as Rich, that they might have to just forgive the whole thing at the end of the day, but we don't know that for a fact yet.
And Bob, my gut tells me they may, if you've got one round of PPP to keep people employed, there could be a second round. That's not in stone, but do you see that as a possibility, Bob?
That may be. There's so much infighting going on right now. I think the next couple of weeks is going to tell, really what's going on, because they're debating all of that in Congress right now.
So just, you have to keep your eye on it. And if it's available to you, and if it's mostly forgivable, there's no reason not to take the money. What's kept a lot of people back from taking the money is the fear that they're going to be audited, and it might be they might be caught spending it where it shouldn't go. Like the guy that is in trouble right now. He made up a company. He got about $5 million. And the first item he bought was a $395,000 car. That probably isn't going to cut it if that gets out. I want to move on to EIDL. And initially, this was a program when there was 9/11, flooding, storms, and damages that you could use, and you could borrow up to, Bob, tell me if I've got the money right, up to $2 million on this program. It might be 5, I'm not sure. I think it's 2.
No, it's
and
2.
Then, excuse me?
2.
Okay. And they kept changing the program. So, and they included we're going to give you $10,000 that is a grant and you never have to pay back. Then it was $1,000 per employee. Now they took that away. What's still available is the EIDL program to get $150,000, assuming you qualify for that. It's very simple to get. And once you get the money, there's no mechanism in place to monitor it. When it starts a year later that you have to pay back. But Bob, anything you want to add to that?
No, that's right now advances aren't available for it, but I think it may come back, and it may come back at the full 2 million. It's there's so much egg on the face of the individuals who put all of this in place that I think that that may come back at the full amount at some point.
So in the meantime, if you could use 150,000, assuming you qualify for that much, it's just as I said on a post that I wrote recently, it's easier to do this than to book a ticket online. When you get your document, there's going to be a lot of gobbledygook in it, on things that you have to do and watch out for this and this. But the reality is there is no mechanism to monitor what you do for the money. And the other good piece of news on this is because it's under 200,000, you do not have to sign personally, which is something you have to do for other SBA loans. So it's out there if you can use it, if you want it, and if you're willing to do it, and you have a 30-year payback period at 3.75 interest, that's easy capital to take right now. The real question is, do you want it? Do you need it? And are you willing to go into debt for $150,000 on a 30-year note? I want to next ask Bob to address Main Street program. There's been a lot of hype on this. There's been a lot of hope on this. And what we're finding is that this is probably a waste of time for most entrepreneurs because the way it's structured. Because of that, we're not going to waste a lot of time on this, but we just want to give you a heads up of why we don't think this program is probably viable for entrepreneurs. And Bob, if there's an exception, jump on it.
Yeah, let me read some, and this is administered through the Federal Reserve Bank of Boston, for one thing. And to apply for it, a bank has to be an approved bank with the Federal Reserve Bank of Boston. So not every bank in the US participates in this. Matter of fact, there are very few. And let me read you a sentence from the header of the Main Street program, and it will tell you everything you need to know. The Federal Reserve established the Main Street Lending Program to support lending to small and medium-sized businesses and nonprofit organizations that were in sound financial condition before the onset of the COVID-19 program. And you know, that's the tenet about it. But when you get into it, there's literally 80 pages of stuff that explain what you need to do to qualify, how to qualify, subtraction of existing debt, covenants, It's a highly intrusive program, and just reading it, I don't know how anybody's going to qualify for it. So, and it really hasn't been implemented like it should have been, and it's still in flux.
So let's leave it there. So if you're interested, we invite you to go online and read the 80-page document and see if you think this is a good program for you. What we're finding right now in today's market, where conventional lenders are very shy and conservative, the best programs are 7A and 504. We're going to talk about 504 first, because 504 has to do with hard real estate. And Bob, what's the good, the bad, the ugly with the 504 program?
Well, with the 504, yeah, you have to have real estate, and it goes up the maximum amount from 5 to 5.5 million, depending on the types of business. The things about the 504 that are really good is that you're getting a blended rate. And what do I mean by that? Well, 50% of the loan is done by a bank on a conventional basis. And then say 30% of the loan is done by the SBA through an investment vehicle called a debenture, usually a bond issued through a REIT. And then the other 20% is your down payment. The REIT portion, or the debenture, is usually at a pretty low rate. Right now, I think that may be as low as 3.75, similar to the EIDL loan. The bank loan is going to be more at a standard rate structure, you know, prime plus 2.5, prime plus 2.75, you know, prime plus 1.5, depending on your company's strength and risk. So you do a weighted average cost of capital of the two of those, and you're going to get a blended rate that's probably in the low fives, or maybe even upper fours, depending on, you know, how strong you are. That's a good thing. But it's an investment loan. There's real estate. There is a prepayment because the bank has to make its interest back, as well as the bond, since it's an investment. Anytime you have real estate, there's going to be a prepay penalty. So on the SBA side, there's going to be a hard prepayment of 10 years. The bank may match it or have their own. That's maybe a flat 5 or a declining 5, meaning that you start out with 5% and it remains the same for 5 years and it goes away. The SBA is going to be at what they call a declining 10, which means it starts out at 10. Year 2, it goes to 9%. Year 3, 8, 7, 6, all the way down to 1, and then goes away. One of the things that the 504 loan will not do is you cannot use it for inventory. Can't use it for working capital. You can't use it for franchise fees.
It's basically for real estate.
Right.
So if you're looking to buy a building right now, if you find a good deal because of COVID, or you want to buy the building you're in, this could be the best way to get commercial lenders, commercial financing for a building. Let's jump to 7A. And as we do this, Lucy, would you bring the next slide up?
Yeah, one final thing on 504, you have to occupy at least 51% of the building for it to be eligible, meaning you can lease part of it out.
You can, but you still need to be the occupant for 51%. Did I hear
Correct.
That right?
That's
okay,
correct.
So let's understand what the 7A program is and why, for right now, with the 4 businesses we're working on, we think this is probably the best way for them to get money in terms of payback time, getting a yes, and getting it in a reasonably quick part of time.
Yeah, the 7A loan also goes up to $5 million. And the 7A, when somebody says, I want an SBA loan, they're usually referring to 7A. It's the garden variety loan. It covers expansion, renovation, new construction, buying land, buildings, purchasing equipment, furniture and fixtures, leasehold improvements, working capital, refinancing debt, seasonal lines of credit, inventory support. It does everything. It covers your fees, your SBA guarantees, and it's somewhere between 10 to 20% down, unless it's a refinance, and it may be 100, but figure on 10 to 20% down. And the rate structures are very flexible. If there's no real estate, there's no prepayment penalty whatsoever. If there is real estate, it's not like the 504. It's short. It's a 5%, 3%, 1%, then it goes away. But you have to be a for-profit business. Nonprofits are not eligible. You have to be able to show good character, credit, management, and ability to repay, which is basically the 5 C's of credit. And being that for a non-real estate loan with a 10-year amortization, real estate loans, 25-year amortizations, the payments are affordable. So for our clients, the flexibility that a 7A is able to handle a lot of different things and will put an amortization out there of at least 10 years, unlike a conventional commercial loan that is, they're usually 2 to 5 years. It's really attractive for our clients.
So there is one thing that I think is important to know. With a 7A loan, they will ask you to sign personally, and they will grab every asset that you have to protect them. And I think the reason for this is a few years ago, the program was loosely run and there were a lot of defaults. Do you want to talk a little bit about that, Bob?
Yeah, and Rich is dating himself there. A few years ago, it's probably 30 years ago. But yeah, you are going to be an unadulterated 100% guarantor. Anybody who owns 20% or greater of the business will be on the hook for the whole amount. There's really no negotiating like on a commercial loan, and you just be ready for it. Also, there's a rule within the standard operating procedure, which is the governing text for the SBA, called the all available collateral rule. By statute, the SBA must go after all available collateral, which means as a guarantor, they're going to go after your homes. Whether you have a first or second lien, it doesn't matter. If the collateral isn't there for the actual business, they're going to go after yours. And it's required by statute, and there's not really anything you can do about it unless you want to replace that collateral with 100% pure collateral, which is a CD.
So the good news is, if you pay your bills, this is irrelevant.
Yeah.
And if you fall behind, you may get some sort of forgiveness on payments for a period of time or an interest-only payment, but you got to be proactive. Go to them. Don't let them catch you. I had a funny situation, Bob, with a company that I got financing for in Austin, Texas. There were 2 owners. One of them lived in Texas, and the other one lived in Colorado. The one that lived in Colorado had to pledge his house. The one that lived in Texas did not, because in the state of Texas, your property is protected from any liens of this nature.
Yeah, that's correct. The bankruptcy rules, and it's not that he didn't pledge his house, it's that the bank couldn't take it as collateral because of those bankruptcy rules. And let me mention something earlier. When Rich was saying about, the deferment on payments or giving some sort of leeway, that's only through the end of September with the COVID process that's going on right now for SBA loans. If you are late, the bank, like any other loan, is going to be knocking on your door and wondering what's going on. There's going to be no discussion about deferments or payments. Red flags are going to go up. Alarms are going to go off. They're going to be calling you. Typically, what I say is SBA products are shelf products, meaning that once you close the loan, they go on the shelf. There's no SBA police that's going to come looking for you. There's no bank covenant officers that are going to be coming at you every month to see how you're doing, unless you miss a payment.
Yeah, that's when you get their attention. So, Bob, I want you to explain, if you will, what's in it for the bank to do a 7A loan? How do they get paid, and what's the probability that they're going to sell that loan?
Yeah, Well, it's not so much how they're going to get paid. That's only part of it. The main impetus for a bank doing an SBA loan is getting that 75% guarantee from the SBA in the event of default. That is the primary reason. And that one thing I learned on the credit side of the bank is that you do everything you can as a banker to protect that guarantee. Because if a loan goes into default and the SBA has to pay on that guarantee, your bank's going to get a big black mark, and that's not going to look too good. The other less attractive, but still very attractive feature is for banks who don't portfolio their own loans, meaning, for example, I worked for it was the 25th largest SBA lender in the US at the time, and it was a $400 million bank, but we were churning, close to 500 million in loans a year. Well, legal lending limits didn't allow us to book all of those on our books. So we sold them in what's called the secondary market. Well, the secondary market, you can sell a loan and retain the servicing, and the bank may get anywhere from 6 to 12 to 14 to 16% return on that loan in investment terms, points for selling that, providing it's structured the way it should be structured. And they usually aggregate those into pools of 5, 10, 15, 25, up 50 million or even bigger, larger pools. So they will get a premium for selling that loan. And that can keep a bank afloat, assuming a bank has 4% that's needed to pay staff and credit officers and bankers on the SBA side of the shop.
The other thing, yeah, Bob, that a bank wants, the loan is really, they're going to make some money on the loan, but they're really looking for you to put your deposits in that bank, to maybe do your credit cards through that bank. We just opened up a bank account for our business, and they want us to do credit cards for them and pay employees on those cards. There's additional fees that banks charge for that, and that's how they make money. If you do payroll through direct deposits with that bank, that means your team of people that work for you get their money through that bank. The auto leases through the bank. There's so many programs that you want to be able to show the bank that if they do business with you, they're going to make money on the other services. And the other key thing to know is, what is your average daily deposit? If your daily deposit, we had a company that accrued their payroll for the course of a whole month, and then they paid it off and started again. So by the end of the month, they had about $2 million sitting in that account. And so their average daily balance was about $1.3 million. And banks will fight to get that. Bob, you want to comment on that before we jump to the last couple slides?
Yeah, that's basically called treasury management. And I worked hand in hand with that department when I was at Texas Commerce Bank here in Austin. Banks, those are called compensating balances. And in essence, the bank will reward you for keeping large balances in the bank, because in essence, those cover your fees. Banks don't make loans. They don't go to the bathroom. They don't do anything without determining what the return of investment is on your account. And that enters into the credit underwriting as well. Maybe not on the SBA side as much as the commercial, but it does. And those deposits are really, they're critical, because the bank will be able to lend based on the amount of deposits sitting in the bank. If you're one of those who says, hey, I ran $3 million through your bank, but your average daily balance is 50 cents, it doesn't mean anything. Doesn't matter. They weren't able to use it.
So Bob, when you say they could use it to lend money, not necessarily to you, but to the marketplace based upon the reserves a bank has at any given time, there's a formula.
Right. The bank, for the Federal Reserve and FDIC, have a certain amount of reserves that they're required to have. and as well as loan loss, as well as deposits, and that's what allows them to lend money.
So what I'd like to do is I'd like to put up the next to the last slide, or the next slide up, but also while we were looking at that, do we have any questions anybody would like us to answer?
We do have a question, and that is, how long does the lending process typically take from application to funding?
I can start with that, and because that's what everybody asks me when I do a loan package. First of all, it depends on how quickly you assemble the information. The sooner you have your ducks in a row, the information you can move forward. So let's say it takes you 10 to 30 days to put together a really good package. Then I would recommend you go to the banks and you shop it. And that may take about 3 or 4 days. And actually, I'd rather the banks come to you. In pandemic times, you have to do it online probably. But afterwards, the banks will send you what they say is a letter of consideration. Bob can give you the exact terms. It doesn't mean that's what you're going to get. And I find a lot of times banks play bait and switch. So you're going to give them the information they need, any additional information, and then you'll get a term loan. So let's say from the time you get that initial letter till the time you get the term loan, depending on how quickly you get the information to the bank, you can add another 2 or 3 weeks to that process. Now, once you get the term loan, there's all kinds of
term sheet, Rich. Term
sheet. Thank you. Thank you, Bob. Bob always corrects me because I need correcting. Once you get to the term sheet, Bob, how long do you see the process lasting? And I'm saying on average, you're looking at a minimum of 45 days, unless you're using an SBA Express loan, which still means you have to have your house in order. Bob?
Yeah, a term sheet means that the bank has accepted your loan package. They've done due diligence, and credit has said, let's bring it in. So once you get a term sheet and you accept it, generally you're going to be 10 days in underwriting, providing it's complete. There's going to be an interview with a credit officer to go over all your data to see how much you know and to test you. Think of it as a job interview for a loan. And so you're going to be in there for 10 days, plus or minus, could be more depending on workload. Then if it's approved, you'll get a commitment letter. The commitment letter, if you accept it, will have the hard terms of the loan. Once you get that, sign it, send in any third-party deposit money, then it's going to be 30 to 45 days to close for a non-real estate loan, 60 to 90 days to close for a real estate loan.
So Bob, are you saying 35 to 45 days once a term letter is accepted and the due diligence has been done?
No, I'm saying 35 to 40 days after the 10-day period after a term sheet has been issued. So you're really adding 10 days onto that.
Okay.
So that's really 40 to 55 days if you consider that process in total.
Yeah, so it's the only other thing you can do if they like what you have, and it looks like once you dot all the I's and cross the T's to go through the process, you may be able to request a bridge loan. And because you need money now to cover things. Bob, let's just take a minute and talk about what a bridge loan is. And then Andrea, do we have any other questions?
Actually, we have one more question, although we're getting very close to the top of the hour.
So let's go with the question.
I don't think a bridge loan really enters in here. Let's see what that question looks like.
Yeah, the other question is, what are the biggest mistakes people make when they apply for funding? So maybe you can give us a couple of quick examples there before you wrap up our presentation for today.
Well, let me start, and then I'll turn it over to Bob. What I find is, particularly you have a relationship with the bank, and you want to go in to year-end, review it, and ask for more money. Too often, entrepreneurs on the way to the bank, pick up their financial statements from their CPAs. They haven't looked at it. It's not right. The balance sheet doesn't work, and they're, to use an industry term, screwed. I think that's the worst thing you can do. You gotta have your ducks in a row before you go to the bank. And I'm going to turn it over to Bob for final thoughts on this.
Yeah, things that can really trip you up that people do all the time. They handwrite their applications that go along with their package. They do not look professional. They look like second graders' homework. Your homework is getting graded. Bankers are going to look at your package, and whatever it looks like is going to be a reflection on how you run your business, and that could kill you at the front door. So that is extremely important. Also, schedules, projections, personal financial statements, everything needs to reconcile and needs to tie into each other. I've seen personal financial statements and projections that say one thing, then when you go to the business plan, there's something else. If the credit officer or the analyst is having to redo all of your math, you're either going to be dropped to the bottom of the pile, or they're just going to say the heck with you and go, hey, this loan's declined. We don't trust the way this person handles its business.
So I want to add two things to that. And could you bring up the next slide so people can see it, please? And we'll talk about what needs to happen. Proper preparation prevents poor performance. Don't go into a bank unless you're ready to get a yes. And that means having all your ducks in a row. And the other thing is, your spirit shows in everything you do. I believe you should bring the bank to your office, have everything look at. I had a client once that hadn't cleaned their desk in 5 years. We had them clean the desk before the bank came in. That was probably the biggest benefit of my service. But the thing is, you want to show the bank comfort in every stage of the process and be prepared. Bob, final thoughts.
Yeah, I mean, be prepared, the old Boy Scout motto. And that's the main thing. Also on your tax returns, make sure you have them. Extensions aren't going to fly, are not going to fly with a bank, you know, in June or July. They're going to expect you to have them done despite what flexibilities are given by the federal government. Have your tax returns done and ready to go.
So before we go, there's a couple other things I want to point out. If you're on this program, there is absolutely no reason not to get our free template and workbook. It will help you every time you go for lending. It explains comprehensively from step one all the way down to everything that works for you. I want to thank our team who've done a great job of putting this together. Andrea, I'm going to turn it over to you in a minute. Lucy, thank you so much for putting this Zoom program together. Andy McKay of EO Austin helped get us prepared for this. Mo did 1,000 details on this. Our whole team worked on this. Bob, thank you. And I'm going to turn it over to you, Andrea.
Thank you, Rich, and thank you, Bob. That was a lot of wonderful information in a very short time. If you feel like you missed anything, we will be emailing you the link to the recording of today's session so that you can go back and look at it. We will also notify you as soon as the free loan package template is available for download on our website. So if you're looking at pursuing capital on your own, you'll be able to use that resource to help you. Thank you so much again for your time. We hope it was worth it, and we look forward to seeing you at another Capital Masters event soon. Thank you.
Yeah, and I would say one more thing. Stay the course. Dot your I's, cross your T's, stay the course. If the money is out there and no one bank who turns you down should mean other banks won't accept you.
With that, we're out of time. Thank you.